just we will actually look at some things today, some strategies that you can use starting in 2025 and then going forward. And then you can get some ideas about things. I'm not going to try to sell you anything, but I am going to tell you what we do in our preferences as well. So let's go ahead and get into this. Before we do that, I have to make the lawyers happy. And so we're going to do this disclaimer here. To the best of our knowledge, the information given in this presentation is accurate as of today's date. Tax changes do happen constantly, and so prior to using this information, you should consult with your tax professional. I'm going to come back to that kind of at the end of this program too. Also, this presentation does not establish a professional or confidential relationship between you, me, or Traders Accounting. And Traders Accounting is not a law firm or a CPA firm. The information provided should not be construed as legal or tax advice. Now, before we get into it, I do want to give you some contact information, and I will put this back up towards the end of the program. Our website is www.tradersaccounting.com/CTU. That is a special link for you all. And when you go there, you can download a free ebook that you can download to your computer and read about it. It has a lot of the stuff that I'm talking about today and some more stuff, and that's free, no obligation there. But if you would like to, if you do want to schedule an appointment, then you can certainly do that. There is a free 30-minute consultation with Raven Johnson. She's our business manager. She's been doing this for decades, and she'll talk to you about the entity that's right for you. So that's up to you. The phone number is 800-938-9513, and our email is learn@tradersaccounting.com. As I said, I'll bring this up towards the end of our slide presentation. Now, what I like to do here is I want to start off at ground level with some basic information. Call it a Business 101 class. And we're not going to get too deep into this, but there are some principles that are very important when trading. And particularly since if you're going to do this if you're going to treat it seriously and you want to deduct expenses and things like that, the IRS demands that you treat it like a business. So we're going to go over some principles here that are very important to know. And the first principle is going to probably surprise you. It's be concerned about your cash flow. Cash coming in, cash coming out. Now, you guys have all been looking at how to get cash in. I would just listen to part of the last speaker, and that's, how to get money in, how to securely make a profit and get that money in. Well, there's two sides to cash flow. There's getting the money in, but there's also the money going out for expenses or for whatever it is that you have to pay for. And businesses that succeed pay attention to both of those. I have a client or a person that I do business with. It's personal. I've known him for decades, and I do his personal books and that. And he has millions of dollars coming in, but he's not making any money. And the reason for it, he doesn't really understand where the cash is going out. And so as a business person, you need to act like a business person with it as a trader. You need to be concerned with the cash going out. And that includes taxes, not just your expenses, but also the taxes going out. And that's what we're going to talk about today. Also, and this is a big one, make your financial decisions based on your business's needs, not the tax code. Every year, usually around December, I start getting calls saying, well, what do I need to do to save on my taxes? Do I need to go buy a car? Do I need to buy an airplane in some cases? Or do you need to buy this and buy this? And I will go through and talk and say, okay, what are you going to use it for? Well, I just want to save on taxes. That's very bad decision making right there. Let me give you an example. I had a guy 20 years ago, I think it was. He was an automobile mechanic and came to me in November, December, and he said, I want to buy a tire machine to save on taxes. I said, okay, how much is the machine going to cost? He said, $20,000. I said, okay, that's going to save you $6,000 in taxes. He said, okay. I said, how much are you going to use it? And he said, maybe once or twice a year. And I looked at him, I said, that's never going to pay for itself. You save $6,000 in taxes, you're going to pay 20,000. You're still shelling out a net total of $14,000. And that has to pay for itself in the long run. So my point here is when you start looking at buying things for your business, whether it's a computer or whatever, don't just buy it to save taxes because that's always a losing proposition. Buy it if you need it for your business, but don't just buy it to save taxes because that's not going to work very well for you. Next thing. Now, I want you to be aware of all your tax and your protection options. It is very important that you understand the basics of the tax code, at least where we're going to be going with trading, and so that you can use this for your advantage and set up what you need to set up in order to make everything happen in the right way. And that's what we're going to talk about here. And then actually, this is the outline of what we're going to look at today. First thing we're going to look at is trader tax status, or some people call trader status or professional trader status. There's a lot of different names for it. And that applies to every type of trader, whether you're trading stocks, options, Forex, cryptocurrency, whatever it is. It all applies to this. And we will talk about that, how to use that. The next thing we will talk about is mark to market. Now, mark to market only applies to stock and options traders. Technically, it can apply to futures, but we do not recommend it because you end up losing some very good tax benefits as a result of it. And then finally, at the end here, we're going to talk about entities. A lot of people have heard, well, I need to set up an entity in order to save taxes or do things better. Well, we will talk about that and what that means for traders. So let's turn our attention first to trader tax status. And trader tax status is actually a choice. I've underlined that, put it in bold, and italicized it. It is a choice. You get to choose whether you do it or not, assuming you meet the criteria. So if you don't meet the criteria, then you can't do this. And what this is deducting your trading expenses on your tax return. So there's a lot of expenses that traders have. You've got data feeds, you've got software subscriptions, your education. I know through Fausto's group here and cyber trading and other things that you pay some money for that, and those are deductible if you meet these criteria. And making and getting those things deducted can actually save some money, obviously, in taxes. We're looking at decreasing the amount of tax outflow, if you will, the cash outflow. So now, if you go to the IRS literature, you'll find that the criteria are very vague. I think the IRS does that intentionally sometimes to allow their examiners a lot of wiggle room. But what we do is we go back to court cases where the tax court has decided certain cases where taxpayers have sued the IRS. They've gone in, they've won these cases, and now we have some criteria to know that when you can use trader tax status or not. So here's the court cases and the decisions that we found out, or actually not the court cases, but first of all, and this is the big one, you have to have 720 trades in a year. Now, that again, that has come out of one of the court cases where somebody sued and won, so they have trader tax status on that. So if you meet that, we can point back to this court case and say, ah, yeah, we've got a court case that says this. What happens if you don't have 720 trades per year? We don't know. I mean, if you want to, if you want to do it and try to challenge the IRS, maybe we can get some criteria and some guidance on that. But that would be kind of costly to do. The second one, there's trading in over 75% of the trading days per year. In other words, we're not counting weekends and holidays, but in the trading days, you need to be trading in 3/4 of those. Now, these two criteria, well, let me get the third criteria before I say that. The third criteria that's come out of a court case, there has to be over 500 hours in trading, research, and education. So really, you should be keeping some type of a logbook to show the number of hours a day that you're doing trading, you're doing research, education. I mean, this right here qualifies as education, attending Cyber Training University. If you go watch a video on YouTube, that qualifies as trading or education. So just keep a logbook of what you're doing and the amount of time it takes. And that takes care of it right there. So what we recommend is that you meet all three of these. And one of the reasons that we recommend that is if you go to the IRS literature, and the big thing that you can get, if you want to get it from the IRS, it's publication 550. You can go to the IRS website, and in their search bar in the upper right, you can type in publication 550, and you can download that to a computer. You can read it on the screen, whatever. But it's really long. It's about 120 pages now, I believe, and it talks about all types of investing. And so you can go to trader tax status and read about the criteria the IRS has, and you find out it's vague. But you do get the sense that they want you treating it like a business. They don't want you just haphazardly trading, making 2 trades a year and then trying to deduct $20,000 of expenses. That's not going to fly. So what they want you to do is they want you to treat it like a business, and these criteria actually do that. You're making a lot of trades. Now, some of you may not think 720 is a lot of trades. I've got clients that do. They do some swing trading, and that 720 may be a little bit tough in a year, trading in 75% of the trading days. So you have to actually put this, and you have to treat it like a business. Now, the tax savings here depend upon your current tax bracket. So I'm not going to give you any definitive numbers as to how much you can save, because if you're in the 22% tax bracket, you're going to save 22 cents of taxes on every dollar that you can deduct. If you're in the 37% tax bracket, you're going to save 37 cents on every dollar you can deduct. So a lot depends upon the tax brackets there, and there's really no way to manipulate that, if you will. Now, trader tax status applies to traders, any trader, doesn't matter, forex, cryptocurrency, stocks, options, for or futures, whatever, doesn't matter. But if you meet these criteria, you can deduct those expenses. Now, if you're an individual trader, a personal trader, and you don't have an LLC, you don't have a business set up, you can still do this. However, there is a warning here. If you do this as an individual, or frankly as a single member LLC, the two are identical really as far as trading goes. There are some things that happen, and you have to be aware of these. First of all, a person deducting trading expenses on the personal tax return must use a Schedule C. Now you say, okay, that's an extra form on my return. Well, there's some problems that come up with that Schedule C. First, because of the Schedule C, your audit risk is increased. The Schedule C is the #1 most audited form by the IRS. The IRS kind of targets it. Now, I'm not saying you're absolutely 100% guaranteed that you're going to get audited, but it does happen more frequently than anything else. So your audit risk goes up if you do this on your personal tax return. Second of all, the Schedule C is kind of wonky. The home office deduction may not be obtainable. There are cases where you could take a full home office deduction. There are cases where it gets limited. There are cases, and which is a lot of times, it gets completely eliminated. So a lot of cases, you can't even use that home office deduction. So that becomes a problem. Now, there's no asset protection. This applies just as an individual trading. With a single member LLC, you do have some asset protection there. And the reason I bring this up is because asset protection is getting to be a very big thing. And you may say, I don't need that. Well, if somebody gets on your property and gets hurt, and and they sue you, and the limits go beyond your homeowner's policy, then your trading assets are wide open. And so they can grab those in a lawsuit, or same thing with a vehicle accident or something like that. So sometimes it pays to have some asset protection. Number four, it is difficult to justify with the IRS having a W-2 job and being an active trader. Um, for whatever reason, the IRS doesn't feel that a person can do both. And you guys and myself have always, you've had two jobs or more in life at times, and that's fine. You make things work. Well, for whatever reason, the IRS doesn't like this combination. And so if they see on your tax return you've got a W-2 job and you're trading securities full time, they start to question things. Now, oh, let me go back. So these are the four problems here that go. And we do have a solution to this. The solution is going to come up here in a little bit after we talk about mark to market. So now let me talk about the mark to market election. Now, this is just for stocks and options traders. We generally don't recommend this for futures, and it's not for any other type of trading. But this is an election with the IRS for stock and options, and any entity or person can make the election provided the TTS or trader tax status qualifications are met, which is why I led off with those qualifications first. Now, what does the mark-to-market election do? Well, first of all, the election eliminates wash sale losses. You pay tax on what you actually earn. Those of you who have been trading for a while know that if you trade the same stock or option over and over again, you can accumulate wash sale losses, which are basically deferred losses. They move in time, and I won't get into a lengthy discussion about what it is, but sometimes those losses actually can carry over into the next year. What does that mean? That means you end up paying taxes now on stuff you actually had lost money on, and that's not good. To market takes away that. There's no wash sales, so you pay tax on what you actually earned. Also, the election eliminates the $3,000 loss limitation. Under cost basis accounting for wash sales, if you lose money in a year, then you are limited to taking $3,000 and then the rest carries forward to next year. So for example, if I'm trading along under cost basis accounting and I lose $20,000, I can only deduct 3,000 on my tax return, and the remaining 17,000 gets carried over to next year to be used up against other capital gains or take another 3,000 on the return. With mark to market, that's not the case. It eliminates that limitation, and if you lose 20,000 a year, you get to write $20,000 off, which is a great safety net. So if you have a bad year, you can write this off against your W-2 income, 1099 income, any other income that you've got. And then if there's still loss left over, that carries over to next year. But the idea is you're wiping out your taxable income, basically. Now, that is a great thing, and I recommend that for stocks and options traders, particularly if you're actively trading, because it makes a lot of sense for stock and options traders to do that. Now, I do want to emphasize that this is an election. So this is something that you have to get from the IRS, although they don't respond to it, but you still have to file the paperwork with them. So it's not a choice like trader tax status. Trader tax status is a choice. You can go back to 2023 and amend your return if you want to deduct expenses for 2023. You could probably still get 2022 in and amend that. There's a 3-year statute of limitations, and certainly for 2024. But mark to market, you can't go backwards with it, with one exception, and I'll talk about that here in a second. This is an election with the IRS. You're going to have to fill out a form 3115 and send that in and before the tax return date. So what does that mean? Well, as an individual, this election has to be made by April 15th of this year. Period. No extensions on that. You can extend your tax return, but you can't extend this. So as an individual, or frankly as a C Corp, this election for 2025 has to be made for by April 15th. And it will go back to January 1st of this year. But you got to get it in, because you get to April 19th or 20th, you're out of luck for the rest of the year. Now, for S corps and for partnerships, those are informational returns. Those elections have to be in by March 15th, which we are pushing that deadline right now. So if that's something that you're interested in, you might want to move on that and get that moving very quickly. Now, the exception to that, if you form a brand new entity, a brand new LLC, it doesn't matter whether it's a partnership, it could be S corporation, whatever, you can actually make the mark-to-market election when you first form that. We put it in what we do when we set up entities is we actually put that in the business records. So there's an official document that you're making the mark-to-market election. And then the IRS, this is a special rule, the IRS does not have to be notified until the first tax return is due, which would be March 15th of next year or April 15th, depending upon the type of entity. So that is something that you might want to consider, because if you're not ready to pull the trigger on this yet, that's fine. You can always create an entity, let's say in August. And then if you do that in August and you set up your brokerage accounting, your brokerage accounts for the LLC, and start trading there, then you can actually have mark to market at that point. So that'd be a way to kind of get around this. And also, the other thing is, if you're currently under cost basis and you set up an LLC, let's say in August, we'll just use that as an example. It doesn't really matter when. Once you stop trading in your personal account and you start trading in the LLC account under mark to market, let's say, your personal account goes dormant, and after 30 days, those wash sales will clear out of your personal account. And so you get a kind of a double blessing there, because you've got now mark to market on the LLC side, and your wash sales are clearing out on the personal side. So that's going to save you a bunch of taxes as well. So that is something really consider. Now, everybody asks me, okay, that sounds awesome. Mark to market's great. Are there any downsides? Well, there are some warnings here. Just like with trader tax status, you got to be careful. Um, First of all, it is not advisable to hold long-term securities in a mark-to-market account. We recommend that if you're going to do mark-to-market personally, that you have an account for long-term securities and you have an account for day trading or swing trading, whatever the quick stuff. And long-term we define as anything more than 1 year. And the reason for this is long-term capital gains has a maximum tax rate of 20%. Most people will fall into the 15% category. You don't want to lose that. And so if you get it close to market, you no longer have capital gains. Now you have ordinary gains, and mark to market will actually get rid of that long-term capital gain benefit tax rate. So you don't want to do that. So you want to separate long-term and short-term into two different accounts. Also, now this is another reason for doing an LLC, particularly like a partnership or an S corp, is you can move the short-term stuff off into the entity, and that is under mark to market, and then you keep the long-term stuff under your personal side. So the long-term stuff is kept as far away from mark to market as we can get it, so that there's no doubt that about it's the long-term capital gains there, and you keep and preserve that capital gains rate for that will benefit you in the long run. Next thing, it's possible in some years to have a larger mark-to-market gain than what is reported on the 1099-B. Every year I deal with some clients who say, well, you calculated the mark-to-market gain, but it doesn't match what's on my 1099-B. And I tell them it doesn't. It's not going to ever. The 1099-B is very heavily dependent on wash sales. You actually have two columns on the 1099-B. Now, the 1099-B is your notice from your broker, your 1099, that tells you what the sale amount was, total sale amount, total cost basis, and then your wash sale amount, and then of course your gain or loss. Well, two of those columns, actually three if you count the gain and the loss, the mark to market, or not the mark to market, but the wash sale column obviously is affected by wash sales, but most people don't realize that that cost basis column is heavily affected by wash sales as well. And so you can't really depend on those numbers at all in order to determine what your mark to market gain is or loss, as the case may be. So the two really don't reconcile very well. And so it's possible in some years, as in most years, you'll have a mark-to-market gain that's smaller than the 1099 gain. In other words, you're saving taxes. But there can be a year where your mark-to-market gain is bigger than the 1099 because some of the wash sales on the 1099 are catching up. So it is possible there, but it's still beneficial just to pay tax on what you actually did rather than having to deal with all this wash sale stuff. Next thing, if you make mark to market personally, and this is for you, and you don't meet the TTS qualifications, you can lose mark to market. Remember I mentioned that those trader tax status qualifications were kind of the key to applying for mark to market. So if you make the mark to market election and all of a sudden you don't trade much, or you have a bad year, like for example, you got family members that have medical problems. We've had clients where that's happened and they haven't, then the IRS can take the mark to market election from you. So that's possible. Now, I found that that doesn't necessarily happen if you've got an LLC like a partnership or an S corp. So that's we've got a safe haven there. So now, turning away from this, now that I've mentioned entities, let's go ahead and turn to entities and see how that helps us. There's several different types of entities. There's sole proprietorship, single member LLC, general partnership, limited partnerships, multi-member LLC, S corporations, LLC S corporations, C corporations, LLC S C corporations. We're not going to deal with all these. Matter of fact, we're going to narrow it down right now. And we're going to eliminate two of them right off the bat. The sole proprietorship and the single member LLC don't do much for a trader. Both of them, sole proprietorship is trading as an individual. Um, and so just doing it on your personal return. The single member LLC reports just like doing it on your personal tax return. So it's really no different. You end up using the Schedule C, you put the deductions on the Schedule C, your income is listed as normal. And as I mentioned before, you have all those problems that come with the Schedule C, like the audit risk increases, and you have potential limitation to the home office deduction and all that stuff that goes on there. So we don't recommend a sole proprietorship or a single member LLC unless the single member LLC is going to go and be an S corp right away. But we'll talk about that in a little bit. The type of entity that's right for you depends upon your situation. Now, in most cases, we don't recommend general partnerships, limited partnerships, or S corporations and C corporations of either type. So basically, we limit our focus to help people. When we try to help people, we limit it to either a multi-member LLC, which is an LLC partnership, or an LLC S corporation. And the reasons for that are several. First of all, the LLC part is critical. One, that gives you asset protection, but also more importantly, and a lot of people don't realize this, an LLC can change how it's going to be taxed. For example, if you set up a multi-member LLC, a partnership, and you go as a partnership, you file as a partnership for 2 or 3 years, and then maybe tax laws change, or you're doing really well and you want to go to an S corporation, that's a simple election with the IRS. You don't have to change anything about what you're doing. You don't have to change EINs. You just have to send an election into the IRS and say, hey, I want to be treated as an S Corp now. Also, theoretically, you could be treated as a C Corp. And then 5 years down the road, you say tax laws have changed again. I want to go back and be treated like a partnership. You can do that as well. So there's some flexibility here that if tax laws change, then you've got some flexibility with an LLC to actually go where the tax savings are the best. So, but for our purposes, we're going to start looking at a multi-member LLC, an LLC partnership. Now, why? Well, there's a couple reasons, and some of these apply to an S corp as well. But I'm one of these people that when I talk to you, I am going to talk to you about not just the pros, but also the cons. I'm not going to set you up for a fall. I want you to know the whole story, and you make a decision based upon that. First of all, here's the cons. If you have an LLC, more than likely you will have a yearly LLC fee. That's true with a single member LLC as well. Most states, you have to renew that LLC, the registration with them. Some cases, like South Carolina, it's 25 bucks a year. Other cases, like California, it's 800 bucks a year. And that's the range. Some states don't have an LLC fee. So I will tell you that. But you do have an annual report that has to be filed every year. So you possibly have an extra fee there. You also possibly, well, with a partnership or an S corporation, you will have a tax prep fee. And you say, well, I don't know about that. Well, the idea is to get this off your personal tax return. We do not want this interfacing with that Schedule C on your personal return, or else you're going to have problems there. So we are going to decrease your audit risk in that by setting it up as a partnership or an S corp. And so you will have a tax prep fee. Now hang on to that because I'm going to tell you how to get it paid for here in a little bit. You also have some increased broker fees for whatever reason. The brokers seem to think if you're setting up a business account, then you've got scads of money and you can pay more in fees. There's some ways to mitigate that a little bit. Some people keep their personal accounts going and they use some of the free stuff on the personal side but do the trading on the LLC side. There's ways to do that. But I do want to tell you about that before, so you do know about it. All right, here's the pros of this. First of all, with an LLC, you have asset protection. And so whatever happens out and this depends upon state too, because LLC laws are different in every state. But by and large, if you get sued personally on the outside, it can't get into the LLC where your trading assets are. So that's a good thing. Um, so you want that asset protection. Somebody gets, like I mentioned earlier, gets hurt on your yard, or you get into an accident on the road and it's your fault, something like that. They can't go after your assets if they're in the LLC. Um, Number two, I mentioned this a little bit ago. You have a choice in taxation methods. An LLC can change how it's going to be taxed. Now, you can't change this every year. But as tax laws change, you can change how it's going to be taxed periodically and therefore go to the optimal place for being taxed. Number three, this is a big one, whether most people realize it or not. It's a reduction in IRS scrutiny. I mentioned a little bit ago that on the Schedule C, if you're doing this on your personal return, either as a sole proprietorship or an individual, or as a single member LLC, you have to use that Schedule C to deduct those expenses. And that raises your audit risk. By putting this into a partnership, LLC partnership, or an LLC S corporation, you bring your audit risk down to almost nothing. Uh, Partnerships and S corps are audited at a rate of less than 0.1%. It's rare that the IRS ever looks at them. I've been in accounting for 35 years at least. I've kind of lost track of how long it's been, but I've seen a lot of audits. Every audit except one has revolved around that Schedule C. And the one that I saw that wasn't actually was an S corp, but it was a payroll audit, had nothing to do with income tax. And those are messy too. But we won't worry about that right now. So I haven't even seen an income tax audit for a partnership or an S corporation. I'm sure they exist, but I haven't seen them. Number four, the home office deduction. When you get off into the partnership or you get off into an S corporation, that home office deduction opens up without limitations. And so we can find the percentage at your home office is we use square footage, find the percentage your office is of your house or apartment, and that gives us a percentage. And then we can write off percentage of your mortgage interest, real estate taxes, or rent, as the case may be, insurance, all your utilities, including cell phone and internet, HOA dues if you've got those, repairs and maintenance, just about anything that goes into your living accommodations, we could take a percentage of that on the home office deduction without restriction. And kind of hang on to that one because I'm going to come back to it in a little bit. Number five, it solves the W-2 trading issue. I mentioned a little bit ago that if you're trading on your personal return, the IRS doesn't like it if you have a W-2 job and you're trying to be a full-time trader. They, whatever reason, have a conflict. Well, what this does, your W-2 job stays on your personal return, and your partnership now is doing the trading. So they're separated. And what it looks like on your personal return is that you got a W-2 job and you're investing in this other business. And so the conflict is resolved there. So that's really a beautiful thing. It solves the mark-to-market long-term, short-term dilemma. I mentioned this a little bit ago that you don't want to get long-term holdings, your investments that you're holding for 1 year or more. You don't want to get those anywhere close to long-term. Well, this solves that because in a partnership or S corporation, you can move your short-term trading off into those entities and then keep the long-term investments on your personal side. And it works out really well. And then the last one is where I want to explore a little bit. The tax savings from this can pay for the LLC. Now, I'm going to focus on the partnership here, but it's true of the S Corp as well. And one of the reasons we don't promote the S Corp right away is there some extra expenses there, like a salary requirement? You got payroll taxes. You probably need a payroll company. So there's some extra fees there that we only recommend that you go to an S Corp when you're really good, making some solid money, and then can go that way. But the tax savings can pay for the LLC. You say, wait a minute. uh, How is that happening? Well, think for a second. You've got the yearly LLC fee that you have to pay to your state, whatever that is, and you got a tax prep fee and maybe some increased broker's fees. Those are the fees, extra fees that you get with an LLC. But by picking up these extra deductions that you get, like the home office deduction and some other things, you can actually use those deductions to reduce your tax enough to pay for those things. Let's take some examples. So if you already have yearly trading expenses, the refund you get from deducting those expenses could pay for the LLC fee, the tax prep fee, your brokerage fees, and then some other things. Matter of fact, you end up start making a profit after a little bit. Here's an example. Suppose a person lives in Illinois, and this is just an example. Your situation is going to be a little bit different, but the yearly LLC fee is $75 per year. And the tax prep fee, we're going to assume is $600 per year. I'm just pulling that out of the air. I don't know what our fee is. I don't keep track of our fees, quite frankly, or anybody else's, but let's just assume. And so that's an extra $675 a year. And people look at that and say, man, I don't want to pay extra $675 a year just to get a pipe dream. No, because what's happening is if this person's in the 35% tax bracket and Illinois has a flat, not 4.95% tax rate, then what can happen if this person has $1,015 in trading expenses and they can get the government to pay for the LLC? Think about that for a second. All you would need is $1,015 in this case to get a refund back to have the government pay for your LLC. Most people have that in the home office deduction. Um, it's my experience, and I've been doing this for quite a while. The home office deduction is usually worth $1,200 a year, at least. Some people, if renting an apartment or something, they can go a lot higher than that. I've seen $10,000, $12,000. Um, so at that rate, this will pay for your home, your LLC right away. So let me go back. So in other words, all you need to do is pick up these deductions, and then you could pay for your LLC. You get enough back in refund or lower taxes, and the government will give you that money back to pay for your LLC. And it really does work out well. It pays for itself when you use it properly. Okay, so what we're going to do is we're going to go to a summary at this point, and then I've got some other things to watch out for here. So here's what we've talked about. First of all, trader tax status allows you to deduct trading expenses if you qualify. Any type of trader can do this if they have at least 720 trades per year, they're trading at 3/4 of the trading days per year, and they've got 500 hours in trading research and education. The mark-to-market election, which we are running out of on the time of doing that for 2025, allows stock and options traders to pay tax on what was really earned and write off entirely what was lost. The great safety net, but it also gets rid of the wash sale, so you're only paying tax on what you actually did. And then, of course, forming a multi-member LLC provides asset protection, decreases your audit scrutiny, and it could be free. And something else that this is my opinion, but it's a gray area with the IRS. I seem to think that if you form a multi-member LLC or an S corp, quite frankly, um, that those trader tax status criteria don't apply nearly as much. And so you get mark to market and then you're not going to lose it. You don't have to worry about the keeping up the trading levels and things like that. You still have to do that on your personal return if you do it there. But on the LLC side, the multi-member LLC, you don't have to worry about it so much. So a multi-member LLC is great. And by the way, one of the things that we recommend to our clients is you start off as a multi-member LLC or an LLC partnership. They're the same thing. And once you've got your trading really well and you're making between 75,000 and 100,000 a year, that's when you want to move into the S corp. We file an election to be treated as an S corp, and then we can set up payroll. We don't do payroll, but together we set up the payroll. We start talking about 401ks where you can start getting maximum benefits out of this and things like that. So that's kind of a roadmap of where we tell our clients to go. Now, there are some things to watch out for here in the future, and I would be remiss if I didn't tell you this. First of all, you probably heard about prop firm trading. That changes everything I just told you. Um, Normal trading, like, you're trading your own money, just subject to income tax. That's it. Prop firm trading, you are actually trading for somebody, another company, and that is actually independent contractor area. And so now you not only have to pay income tax, you got to pay self-employment tax on that as well. So it changes the dynamics of everything. So if you're going to get into prop firm trading, I would suggest you get some advice on that, on how to handle that. Number two, and this is one that a lot of people are surprised at, some ETFs, and SPX is the big one, are treated like futures contracts. SPX, VIX, NDX, there's 6 or 7 more. They aren't traded in New York like the other ETFs, and they're not traded like stocks and options. They're actually traded in Chicago on the Mercantile Exchange. And so therefore, they are treated like futures contracts. So if you start trading SPX, as an example, you're not trading regular stocks and options anymore. And mark to market's not going to apply. You're now trading like futures, even though it's not classified as futures, but it's treated like futures tax-wise. And now you've got a whole different ball game going on. So that might be something to get advice on if you're going to go down that road. Number three, trading other people's money or even giving them advice can create major problems. You'll notice in the webinars that you've been taking here, and probably maybe some other things that you've been doing, they don't recommend to you stocks to buy. They'll tell you how to do your research, how to find them for yourself, but they will not recommend which stocks to buy. And that's because once you start recommending stocks, you have to be licensed by the SEC. The same is true for investing other people's money. And invariably, I have maybe one, two a month that people ask me, I'm setting up the LLC here. My wife's the other partner. Um, and I got some family members that want me to invest their money. And I say, don't do it because you can get into a lot of trouble that way. There are ways to kind of structure things to help get around it a little bit where they have to be partners or something like that. But that's another thing you're going to need to get advice on. But just don't take somebody's money and manage it or even get into their account and manage it because you can get into a lot of trouble that way. And the last one, which is everybody spooking everybody, is the new administration. I know I was watching talk about the tariffs and how that's kind of upsetting the market. There's other things going on, and it's part of the natural cycle, I'm sure. But we're also watching other things, and this is a time right now of uncertainty, quite frankly. And we will get through it. Traders always do, and probably bounce back even better. But the tariffs are playing a part in the stock market right now. Um, there's a lot of talk about eliminating the IRS. I was reading about that today. Well, you're not going to get Congress to make any changes in the tax laws right now. Matter of fact, I've heard people saying, "Well, I may not file my taxes until I find out if they're going to eliminate the IRS." Well, they're not going to eliminate it this year. I mean, well, at least not right now, not before tax time. So if you're waiting on that, you might as well just file your tax return because Congress has to get has to take care of that. And Congress, that's not even on their plate right now. So it's probably they will pick something up, tax tax changes, eliminating IRS, whatever it is. Um, that's going to happen probably at the end of the summer, maybe in the fall of this year. Too late for anything as far as 2024's taxes. So don't wait for anything like that, but do keep an eye on it because we could eliminate the IRS. We could get major tax law changes, something like that. There could be a lot of things going on. So that is something to really keep an eye out on, watch for, and get good advice on what you're doing and somebody that you can rely upon. Now, let me go back to our information here. I said I would bring this back up. Again, our website is www.tradersaccounting.com/CTU. There is a free ebook there that you can download. It has a lot of stuff that I was talking about and some more stuff there. You can download that, no obligation necessary. We don't even know you went on the website. I think there's a counter, and that's about it. But you can download that. You can read through it. You got some advice there. The phone 800-938-9513 if you want us to do your taxes. Let me tell you what we do here real quick. First of all, we can set up those LLCs for you. If you're interested in setting up a multi-member LLC, we can do that for you. If you're interested, and by the way, with LLCs, multi-member, you say, well, I'm alone. I don't have any partners. I don't have any family. There's ways to do it. We give us a call. There's ways to actually get it done, believe it or not. Um, so we set up LLCs. We do bookkeeping for trading clients to keep track of their profits and their loss. Matter of fact, mark to market every month. We can tell you what you made, you lost, and your expenses. Also, of course, tax preparation. We do personal tax prep as well as any of the entities that I've mentioned above. So we can take care of those needs for you. We don't do the payroll for the S corporation, though, just kind of let you know, but we'll help you give some recommendations as to who to contact for that. And then also our email is learn@tradersaccounting.com. So we will be standing by if you want to give us a call to set up an appointment. I think you can go to the website there and you can make an appointment right there. And certainly that would if that'd be great if we could talk to you. Again, there's a free 30-minute consultation with Raven Johnson. It's not with me. It's with Raven Johnson to talk about what type of entity would be good for you. You'll have to tell her about your situation, what you're trading, and how things are going with you. And then, but that will come into play, and she will happy to sit down with you and do that for you. So what I'm going to do here is I am going to stop the share. Hopefully you've got the information off of the screen there. Again, the tradersaccounting.com/CTU, and then our phone number is 800-938-9513. And then I'm going to turn to questions here. So I'm going to bring up um, the chat. And Fausto, you here?
Yeah, I'm here, Jim. Everything looks, Jerry. Everything's good here.
All right, good.
I had a question for you.
Sure.
So, is there any new changes for 2025 that anyone should be concerned about?
Actually, Congress has not done anything major in the last few years. The only thing, there is one thing coming across. If you remember back in 2017, they had the major tax revision then, where we got bonus depreciation and the new standard deduction for individuals and things like that. Well, when they made that tax plan or that tax policy in 2017, they did not set it up permanently. And so those things are phasing out. So the bonus depreciation now is down to, I think, 60% this year. The standard deduction is set to go back to what it was with the exemptions and the standard deduction at lower rates here in a couple years, which is why Congress is going to have to act on this fairly soon. So as far as nothing major from last year to this year, but we do have some things that are going on in the next couple years.
And then just to reiterate, I know you mentioned this before, and I'll just remind everybody one more time. So, regarding about the deductions, the money you spent towards education, is that tax deductible?
Absolutely. If you meet the criteria for trader tax status on your personal return, or if you do it in a multi-member LLC or an S corp, that's fully deductible.
Okay.
Absolutely.
And if I go on vacation and I do a class, or if I'm trading on a vacation, can I write off that vacation?
That is something you have to be very, very careful with. I have clients ask me that all the time, actually. And what I tell them is if you go on a trip, you need to have a business purpose for that trip, and you need to document it well. Now, if it just so happens you see family members or you just happen to go to the beach or whatever at the same time, fine. But make sure you've got enough documentation there to show that it is business related, then you can do that.
Okay. So if they log into my webinar or something in my class or something, will that count for it?
Well, I think it's got to be when you go to the place, there's got to be something indicative at the place that
Okay.
not just because you can log into your website anywhere, right?
Yeah,
Because
yeah, yeah, of course,
you're
of
you're well
course.
known all over.
Well, like I said, and just to let everybody know, I always get this all the time, and people ask me this, and it's just it boggles my mind, Jerry. But everyone's like, "So you make all this money? How you pay the? Now you got to pay taxes on this." And I always tell everybody, "Listen, if you're worrying about if you're paying taxes, that's a good thing. That means you're making
Hmm.
money. It's when you're not paying taxes that's
Yep,
a major problem. That means you're not making money.
that's right.
You got guys like you got traders accounting that will help you figure that stuff out, and
Hmm.
that's why they're here today. So don't worry about you know paying how much taxes you're going to pay in this. You actually probably would pay less, I think, doing
Hmm.
this as a business, because that's another misconception people get. They think like, oh, my account says it's going to be in this tax bracket now. It's going to be capital gains and all this stuff. And I just tell them your account doesn't understand the trading business.
Yeah.
That's really comes down to it.
It is complex, and then you need to find somebody that does understand what's going on so that you can maximize your deductions. Now, as I led off with, you don't go out and just spend money to save taxes because you always lose money that way. But to maximize the deductions you have and make sure you get the best tax advantage, you need somebody to help work with you and you need a partner there,
Yeah.
really.
And Dame has a question right here coming across. Is if you're able to write off losses from our trading activity as well?
Yes. Well, losses. It depends on whether you have mark to market or not. If you're not under mark to market, if you're doing the cost, I can't think the cost method of accounting, then you're limited 3,000 in a year, but the rest carries forward to next year so that you can offset other capital gains next year. Now, if you've got mark to market, you can write it all off, no matter how much it is.
Is it still the $3,000 the most you could write off?
Yeah, under the cash basis method, 3,000 is the most that you can write off on your tax return.
Okay. Before I let you go, and I was trying to still figure this one out, but I know that the Biden administration was
Hmm.
trying to pass a law that, if you made money in the stock market, they're going to tax you on it.
Hmm.
But my thing is like, well, how do you tax somebody when you didn't even take a profit yet? And then what happens? What about my losses? If I lose 50 grand and I don't have any money to pay for it, are you going to give me the money, pay me back the taxes on that? So like,
Yeah. That actually, what they were trying to do is convert everything to market. And mark to market, you if you put that long-term investments under mark to market, you do end up paying tax on money that you haven't even realized yet, which is
right.
why went through the whole spiel about keeping your long-term holdings away from mark to market. But the last administration was going to make everything mark to market, and it would have turned out to be a mess because it would have destroyed the market.
It
Not
would
that
have
it,
destroyed the market. It
yeah,
would destroy the market. So I just don't get it. But anyway, Jerry, thanks for coming here. And once again, I got to have you back on my podcast, and so we can sit down and have these type of conversations.
sounds great.
I know you gave a great lesson here, and that's why we had you here. But last time we were on the mic and we had a podcast, everyone loved it. We had a great response, and I have a lot more questions, but I want to take your time because we're out of time, and people have been here all day. So
Yep.
thanks for coming, Jerry, and everyone. Thanks for coming here at Cyber Training University Cyber Expo, and we will see you all tomorrow morning. I will be broadcasting another event tomorrow at 12. We'll send you the link. Hopefully, guys, if you missed my morning, we're going to do a totally different one tomorrow. So, Jerry, thanks for coming. And
All right, thank
everyone,
you.
happy trading. And we'll see you then.